And good evening, everyone. I'm Sue Herrera, in tonight for Susie Guerra.
And I'm Tyler Mathisen. Welcome from me as well. Remember those stock market records from a couple of weeks ago? Well, you can forget about them for now. Today, stocks had their worst session in months, almost 6 months to be exact for the Dow Jones Industrials. It fell 317 points to finish at 16,563. NASDAQ slumped 93 to 4369, and the S&P 500 dropped 39 points to 1930. And change. All 10 S&P 500 sectors were lower today. All 30 Dow components lost money too. Now look at this graphic to see how far the major indexes have slid since their peak just a few days ago. Small company shares have suffered the most. The Russell 2000 is off almost 8%. And if the indexes weren't negative already for July, today's losses made them so. The monthly drop for the Dow and the S&P was the first since January. For the Russell, the worst since May of 2012. Here's Bob Pisani.
It was an ugly start and an ugly close for the day. There were several reasons for the drop in the markets. First, it started in Europe. Portugal's biggest bank reported a multi-billion-dollar loss, much greater than expected. Second, the rhetoric in the Ukraine is heating up, with the prime minister there saying Russia was seeking to revise the outcome of World War II by annexing the Ukraine and fomenting war. Then Argentina, defaulting on its debt, put pressure on Latin American stocks and other emerging markets. Then interest rates in the U.S. spiked when a gauge of employment costs came in much higher than expected. That had many worried that it may cause the Fed to hike rates sooner rather than later. Finally, we had a number of big companies with disappointing earnings or guidance, including shoe manufacturer Adidas, which has had considerable sales in Russia, and home builders Ryland and Beazer, both of whom reported disappointing earnings. Now, we get the July jobs report tomorrow. Traders want to see clear signs that the job market improvement is continuing. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And joining us now to talk more about today's sell-off and what it means for you and your investments, Art Hogan joins us. And of course, he's a market specialist, and he is with Wunderlich Securities. Good to see you, Art. What do you make of what happened today? I mean, does it change the overall bull trend that you have been predicting and have been right on so far?
No, I don't think it does, Sue. I think it's helpful to, take everything that Bob just went through and aggregate it. And I think what really happened today was we got some physical evidence of what we've been concerned about on the global macro. And by that, I mean all of these things, Russia, Ukraine, the Gaza, Israel, geopolitical hotspots around the world, are emotional events. But when we actually get physical evidence, whether it was the deflationary economic report out of the Eurozone today, or Adidas and InBev and ExxonMobil all talking about a slowdown in demand because of what's going on in Russia. And I think that's why the market manifested itself in a sell-off today. And oh, by the way, this is a sell-off that's been a long time coming. I think we've gone a considerable period of time without much volatility whatsoever. So I think this is the garden variety sell-off that we're going to see. We're down 3% on the S&P. I don't think we get down much more than that. We closed on support. We'll see what tomorrow brings.
All right, let's bring in John Stolfus. He's Chief Market Strategist with Oppenheimer and Company. John, welcome.
Thanks, Tyler.
What happened today? Was it a hiccup or something more?
Tyler, I'd have to say I think it was a little bit more than a hiccup. It was a confluence of things from around the globe that have already been mentioned. We'd add to everything when you consider the impact of just a potential speed bump with Argentina. We've been through this before with Argentina over the years, but it all leads to a good opportunity to take profits. It hasn't been a bad year on the back of 2013 when we were up about 30. So we would have to think that at this juncture, a little bit of selling, and we've been here before. In February, we had a spike in the VIX. We had a pullback, concerns about growth, but we are in the process of an economic expansion coming out of an economic recovery that has been significant.
So Art, in the past, as John just pointed out, we've had these hiccups, or in some cases, more of a sell-off. And the lesson to be learned from those was that you should have bought. Do you feel the same way with today?
I do, Sue, and that opportunity might not represent itself tomorrow. It's a Friday, it's the summertime. We've just had one of the worst days we've seen in 6 months. But I think as next week begins and we start to see the dust settle a bit, you're going to realize that when these things happen, realize the market was down pretty much across the board, almost the exact same percentage point, and nobody was running to gold, and bonds weren't acting funny. So you've got a market that basically was risk off. Every indice seemed to be down about 2%. That creates bargains. You want to get at your shopping list and look at what stocks have been sort of tarnished with the same brush that everything else was sold with, and look at the stocks that you've been waiting to buy, but have gotten ahead of you. So I think those opportunities probably come, and they probably come as early as next week. I think tomorrow might be another day to wait and see. It's very difficult on a Friday in the summertime after a very difficult day like we had today.
John, if this turns out to be a buying opportunity for equities, what would be on your buy list?
Tyler, I would be looking to add technology, industrials, materials, and select items in consumer discretionary.
Tell me about consumer discretionary, because we've had some bumpy results out of the consumer sector. What are you driving at there? What kinds if you don't want to name names, go ahead. I invite you to. But if you can't, what kinds of companies are you pointing to?
Well, I'd be glad to mention a few names. Companies like Home Depot and Tiffany's would be among those that we'd want to buy. Sort of a barbell there, home renovation, and on the other end, quality jewelry, both at affordable end as well as the expensive end. And on a global basis for Tiffany and, of course, Home Depot, it's a U.S. story. We would also consider here within the consumer discretionary arena, we'd want to be still exposed to automobiles. Average age of the automobile fleet remains stuck at around 11 years, and people are going to continue buying cars.
All right, we'll leave it at that. All right. Home improvement and Tiffany's. You can wear good jewelry as you repair your home. Thank you, guys.
You get me the
Appreciate it.
hammer, I'll get you the rings.
There you go. All right, Art, John, thank you.